Riders. Our study of life insurance policy options and riders concludes with a look at common policy riders that enhance a policy's death benefit coverage. Guaranteed Insurability Rider. The Guaranteed Insurability Rider allows the purchase of additional life insurance coverage without requiring the insured to provide evidence of insurability. It assures policy owners that they'll be able to increase their life insurance protection even if the insured becomes uninsurable. This rider is sometimes referred to as a purchase option rider or additional insurability option rider. It is generally available only with permanent life insurance policies. Rider provisions. Guaranteed insurability riders let the policy owner buy more life insurance of a specified amount on specified policy anniversary dates, called increase option dates. Insurance increase option dates typically occur every 3 years on the policy anniversary date. Some policies specify that option dates are the anniversary dates nearest the insured's age of 25, 28, 31, 34, 37, and 40. While most option periods go only to age 40, some go to age 65. In addition to these specified option dates, the rider may provide alternative option dates to recognize special life events, including marriage and the birth, or adoption, of a child. Exercising an option on a special basis eliminates the next scheduled option date. Premiums for the coverage bought under a guaranteed insurability rider option are based on the insured's attained age when the option is exercised. Most policies require that options be exercised within 30 days before or after an increase option date. Key point. With the guaranteed insurability rider, it's use it or lose it. If the policy owner decides not to exercise the right to buy additional coverage on an option date, that option is lost and the policy owner must wait until the next option date to increase coverage. Limits. The rider specifies the maximum amount of additional insurance that may be purchased. While exceptions exist, the maximum amount is usually limited to the lesser of the face amount of the base policy or a specified dollar amount, such as $50,000 or $100,000. If the policy owner chooses, the increased coverage can have the same optional benefits as the original policy had, with the exception of a guaranteed insurability rider. Possible additional benefits include waiver of premium and accidental death benefit. Guaranteed insurability and universal life. A guaranteed insurability rider can be added to a universal life insurance policy. However, UL's flexibility requires some changes with how the rider works. With traditional permanent life policies, exercising an option results in a new additional policy being issued. With UL, exercising a guaranteed insurability option results in an increase in the underlying policy's specified amount, i.e., death benefit. Also, the future cost of monthly insurance deductions is increased. This increase reflects the new net amount at risk resulting from the added death benefit. Accidental Death Benefit Rider. An Accidental Death Benefit, ADB, rider provides an additional amount of insurance if the insured dies as a result of an accident. The additional amount is typically double or triple the amount of the base policy's face value, which is why these riders are sometimes called double indemnity or triple indemnity riders. Some policies today let the insured buy a rider for any multiple of the face value. Because additional death benefit coverage is being provided, these riders require an additional premium. An ADB rider pays its additional benefit only if death occurs as the direct result of an accident. Also, the death must occur within a stated period following the accident, typically 60 or 90 days. Most insurers limit the age at which the insured policy owner may add an ADB rider, for example, age 50. Most of these riders expire when the insured reaches age 60 or 65. When the rider expires, the premium charged for it also ends. Cost of living rider. A cost of living, COL, rider gives the policy owner the option to continually increase the face amount on his or her policy to fight inflation. This type of rider is tied to an inflation index such as the Consumer Price Index, CPI. As the CPI increases, so does the policy owner's coverage, without requiring the insured to prove insurability. Insurance companies offer different forms of the call rider based on the underlying policy. Common examples. The call rider on a whole life policy is typically an increasing term insurance rider. The CPI-driven rate of increase is usually capped at about 5% per year. Adjustable life policies increase the policy's death benefit. A call agreement can also be added to term policies. Universal life policies, with their highly flexible terms, are not good candidates for the addition of a call rider. Return of premium rider? Available with some term life insurance policies, the return of premium rider pays the policy owner a sum equal to all or a portion of the premiums paid if the insured is alive at the end of the policy term. Interest is not included in the return premium, nor is the cost of the rider. If the policy is canceled before the end of the policy term, no premiums are returned. Term riders. A term rider can be added to any policy to increase the death benefit payable if the insured dies during the specified term. A term rider provides an additional death benefit for death due to any cause. Term life riders of all forms are usually less expensive than comparable term life policies issued separately. No lapse guarantee rider. Variable universal life, VUL, policies typically include a no-lapse guarantee provision or rider that prevents the policy from lapsing should policy cash values drop below the minimum amount needed to support the policy, due to a drop in stock prices. If included as a policy provision, no additional premium is charged. If provided as an optional rider, an additional premium may be charged. For your review. With the guaranteed insurability rider, additional coverage can be obtained without requiring the insured to provide evidence of insurability. If the additional coverage is not purchased on an option date, that option is lost and the policy owner must wait until the next option date to increase coverage. With UL, exercising a guaranteed insurability option results in an increase in the underlying policy's specified amount, i.e., death benefit. An accidental death benefit rider pays its additional benefit only if death occurs because of an accident. The call rider on a whole life policy is typically an increasing term insurance rider. Increasing term insurance is normally used as the return of premium rider, with the rider benefit scheduled to equal the total premium paid to date.
Okay, so here's our 4 questions for this lesson. Which rider gives the policy owner the option to increase her insurance face amount on an inflated index? I don't know the answers to all these. I'm taking the test with you here, so I'm guessing accelerated. It will tell me what's right and what's wrong at the end. Which of the following statement correctly describes the accidental death benefit ADB rider on a life insurance policy? So I'm going to click this one because usually if it says it in the next question, the one before, I said accelerated benefits rider. Inflated. I'm still going to go with that. Or it should be inflation index should be cost of living, right? All right, let's go. Which of the following describes the accidental death benefit rider on life insurance? It should be an accidental death. It pays only in the event of an accidental death or sudden illness. All right, I'm going to go with that. All right, policy owners can buy additional life insurance policy in the future without proof of insurability with a guaranteed insurability rider, maybe, or a term rider, I don't know. All the following are type of riders that are available with most life insurance policies except a guaranteed dividend rider, because I never heard of that. Oh my God, I got them all right. Let me take a picture. Hold on. This rarely happens. I'm telling you, I can't even believe it. And I totally guessed on all of these. All right, which rider gives the policy the option to increase his or her life insurance policy face amount, the cost of living? And I've seen inflation, which is cost of living, CPI, cost of living, and consumer price index increases, so does the coverage. So that kind of just made sense. Now this one here, kind of the same thing, accidental death, right? So the answer is it pays only in the event of accidental death. I was kind of going back and forth between, it could be this one too, but luckily I went with my first instinct on that one. All right, this next one is Policy owners can buy additional without proof of insurance if they got the guaranteed insurability rider. All right, another question 4 is the guaranteed dividend rider. Because I've never heard of it. Okay, but policy dividends can never be guaranteed by rider or otherwise. So this one was a perfect length. It was 10 minutes, which I like to keep my videos like this about 10 minutes. All right, the next video we're going to have here is uses of life insurance. So stay tuned if you're following along.